Let's cut through the noise for a second. If you open any financial app or turn on the news, you're bombarded with the same message. Invest in the stock market. It's the only way to build wealth. S&P 500 or bust. It sounds so simple, right? Just click a few buttons on your phone, wait 30 years, and boom, you're a millionaire sipping margaritas on a beach.
But here's the reality that most finfluencers won't tell you while they're showing off their rented Lamborghinis. For the average person, the stock market can feel like a legalized casino where the house always wins. We've seen crashes that wipe out decades of savings in weeks. We've seen stable companies vanish overnight.
So, today we're asking the uncomfortable question. Are stocks actually a smart investment for you, or are you just exit liquidity for the big players? Before we dive into the numbers, we have to talk about the stock market lie. The lie is that the stock market is the economy. It's not. The stock market is a collection of expectations. When you buy a share, you aren't just buying a piece of a business. You're betting that someone else will be willing to pay more for that piece of paper later. It's a game of psychology as much as it is a game of math. Now, if you look at the historical charts, the bulls will tell you that the market returns about 10% a year on average. And on paper, the math is beautiful. $500 a month turns into $1 million over time. But here's what they don't show you on the chart. The 20% drops that happen while you're trying to pay for your kids' college. The 10-year stretches where the market goes sideways and does absolutely nothing. The average 10% is a smooth line that covers a very, very bumpy road. Most people aren't built for that road. Our brains are wired to survive, not to watch our life savings evaporate on a red screen. When the market dips 30%, the smart advice is to buy more. But in the real world? In the real world, a 30% dip usually happens when the economy is tanking, people are losing jobs, and you're wondering if your company is next. That's when most regular investors panic and sell at the bottom. That's the squeeze. And that's why the average investor rarely actually sees that 10% return.
So, are stocks a scam? No, but they are a tool that is frequently misused.
Think about it like this. If you don't have a solid foundation, if you have high-interest credit card debt, or you don't have 6 months of cash under your mattress, the stock market is the worst place for your money. Why? Because you're playing a long-term game with short-term money. The stock market is a place for money you don't need for at least 5 to 10 years. If you put your emergency rent money into Nvidia because it's trending on Reddit, you're not an investor. You're a gambler who forgot to go to Vegas. Let's look at the alternatives, because the stocks are king crowd hates talking about them. Real estate? It's tangible. You can see it, touch it, and people always need a place to sleep. But it's a headache. You've got property taxes, leaking roofs, and tenants who might stop paying. High-yield savings? Safe, but as we've discussed before, inflation will eat you alive.
Stocks sit in this weird middle ground. They offer liquid wealth, meaning you can turn them into cash instantly, but that liquidity is exactly what makes them dangerous. It's too easy to sell when you're scared. You can't panic sell your house on an app at 2 a.m. on a Tuesday, but you can panic sell your entire retirement portfolio.
But here's where stocks actually become a smart move. It's not about picking the next Apple or Tesla. Trying to find the needle in the haystack is a loser's game. The smart way, the boring, unsexy way, is to buy the whole haystack. When you buy an index fund, you're betting on human ingenuity.
In 2026, the game has changed a bit. We have AI-driven trading, high-frequency algorithms that move faster than you can blink, and a global economy that feels more fragile than ever. The buy and hold strategy is being tested like never before. So let's get practical. How do you actually make stocks a smart investment? First, you have to kill the lottery mindset. If you're looking for a 10x return in a year, go to the track. Investing is meant to be boring. If it's exciting, you're probably doing it wrong. The smart money treats stocks like a tree they planted. You don't go out and dig up the roots every morning to see if it's growing. You just make sure it has water, and you leave it the hell alone for 20 years.
Second, you have to understand fees. This is the silent killer of the middle class. A 1% management fee sounds small, but over 30 years, that 1% can eat up to a third of your total wealth. A third! That's years of your life worked just to pay for some guy's yacht.
Third, you need to diversify, but not the way you think. Diversification isn't just owning 10 different tech stocks. That's just one sector. Real diversification is having a life that isn't dependent on the ticker tape. It's having skills that make you money regardless of the market. It's having a side business. It's having a home. Stocks should be the engine of your wealth, not the whole car.
Is the stock market rigged? In some ways, yeah. The big banks have better data, faster computers, and more connections. But they have one weakness. They have to report earnings every 3 months. They are forced to think in the short term. You, the individual, have a massive unfair advantage. You can wait. You don't have to answer to shareholders. You can hold for 30 years while the big guys are panicking over a bad quarter.
Time is the only thing that turns a risky bet into a smart investment. If you're 25, the stock market is the smartest place on earth for your money because you have the time buffer. If the market crashes tomorrow, who cares? You've got 40 years for it to recover. But if you're 60 and all your money is in aggressive growth stocks, you're playing a very dangerous game.
At the end of the day, stocks are a smart investment if and only if you have the stomach to be wrong for a long time before you're right. Most people can't handle being wrong for 5 minutes, let alone 5 years. So before you put another dollar into the market, ask yourself, are you buying because you understand the business and the long-term cycle? Or are you buying because you're afraid of being left behind? Fear is a terrible financial advisor. The stock market is a tool to capture the growth of human civilization. It's a way for a regular person to own a piece of the greatest wealth-generating machines ever built. But like any powerful tool, a chainsaw, a car, a crane, if you don't know how to handle it, it'll hurt you. Respect the market, but don't worship it. Keep your cash reserves high, keep your debt low, and treat your stocks like a long-term partnership, not a one-night stand. Because in 2026, the middle class isn't going to be saved by a politician or a lucky break. We're going to be saved by our own discipline and our ability to see through the hype. What's your move? Are you all in on the market, or are you looking for the exit? Let's talk about it in the comments. I want to know what your portfolio actually looks like. Not the dream, but the reality. Thanks for watching. Stay smart, stay skeptical, and keep building. I'll see you in the next one.